In this video, we're going to ask, is the low in? There's a lot of data to be aware of, and a lot of things that we need to understand. Crypto is influenced by the main markets, and if you don't understand the connection between crypto and the main markets, you will lose money. Understanding how yields impact the market is also quite important. Macroeconomic factors really do matter, as is understanding the power of the DXY, or the US dollar currency index. We look at the technical structure of the markets and see what is likely. Stay tuned, it's going to be awesome. Hi everyone, I'm Ken from CryptoTradingKS, and the inventor of the CTKS method that reveals smart money buy and sell levels, BORSOG trading, which helps you to get into sync with the markets, and the CTKS Masterclass to transfer 30 plus years of skills in the financial markets to you so you can become your own financial advisor. If you're new, a very warm welcome, and welcome back KS family. Each and every day I explain the smart money mindset to assist you to be more of a financial blessing to yourself and those you love, gaining real wealth and positive excellence in the process. If you would like daily updates on price movements in the crypto market, as well as the stock market 7 days a week, 365 days a year, please subscribe to YouTube. I've left helpful links in the description of this video, such as the tax software I use, and also links to the CryptoTradingKS Masterclass. Please seek out a CTKS ambassador to get 80% off. And if you're in financial hardship, you can apply for the partial Masterclass scholarship. The link is in the description as well. Thank you very much to our moderators for keeping our community safe from scammers. And please note, I don't have WhatsApp or Telegram. Please consider sharing and liking this video and also subscribing to the channel. Let's run the numbers. Bitcoin is currently down 1.34% to 19,177. Ethereum is up 0.29% to 1297. In answering the question, is the bottom in, we must consider Rule 225. Bitcoin cannot escape the stock market's gravity. One thing we do as crypto technical analysts, we look outside the crypto market because it's really, really important to do. And how do we look at any particular market? We look through the CTKS method. Marking up our charts with the CTKS method allows us to understand where structural support and resistance levels are. They're structural. They're not based on recent price action. They're based on all of price action. I invented the CTKS method to help people understand where institutions were focusing on buying and selling. A lot of times, people new to trading and investing will just look at a chart from recent price action. If you look at a chart from recent price action, where is the support level below? And how do those support levels stack up? It's very, very difficult without a scientific process. The other thing to understand, the markets don't reward guessing. They reward knowledge. The more effort and energy you put into understanding the market, the more the market will reward you. Pay particular attention to this basic structure I'm going to pass across to Bitcoin. Bitcoin is currently $19,171, and you look at the various smart money buy zones and smart money sell zones. Let me zoom in here on current price. When we look at Bitcoin, we saw that the smart money buy zone was between 17,931 and 18,407, and we got a very decent spike back in there. What actually happened? The institutions were liquidating the shorts. And where did those liquidations take us to? About midway in the smart money sell level. One particular thing that you must keep in mind at the moment is this Armageddon line, 18,942. 18,942 is a critical line in the sand. If we trade below 18,942, we could come back and retest that and resume down. A lot of people are calling the bottom is in, but there's so many things that you need to look at to gain context. Right now, we're in no man's land, but we have to pay attention to what price does next. If it falls below the Armageddon line, that shows a structural weakening of price. The good thing is the Armageddon line has been defended time and time and time and time and time and time and time again. This is a really good thing, but we've seen in past cycles of Bitcoin, we get a defense of an Armageddon line. If it breaks down, it will break down badly. We can also look more deeply into market structure, looking at the total crypto market cap. This includes Bitcoin, Ethereum, and all the alts. We can see total crypto market cap is currently $881.951 billion. To get very specific on where the crypto market could be at the end of the week or end of next week is very much tied into Stanfield lines. Stanfield lines or Stanfield levels are very specific price points. They're different from zones. Zones will define an area of price action. Levels are very specific in their pricing structure. What we can see here is we have two very key levels, 866.469 billion. If the market falls below this, we would expect it to go to the next support level. Where is the next support level? It's down at 644 billion. This means we could be in for quite a drop if we actually lose this support level. That's something that you must bear in mind. And the stock markets have very similar structures. The financial markets have definitely turned from investing to trading markets. Traders get in and out of positions. We're likely to see turbulence that is very, very good for trading for the next several years. If you're an investor who doesn't trade, picking up the skills of trading is a very, very profitable thing to do. You can time your entries and your exits far more effectively. So we've covered off the negative case. We can see there's not a lot of support in the market at the current time for overall crypto total market cap. But what if we go the other way? Where are the resistance levels? One is at 905.13 billion. Remember, this is the total crypto market cap that we're looking at. Let's just zoom out here a little bit and I'll show you some higher level ones. If we get through that 905 level, the next one is 1052 trillion. And we've got a heavier resistance line or a smart money sell level. The smart money is always selling when the price is going up. And that's in stark distinction from retail traders and investors. They buy when they should sell, and they sell when they should buy. The rules of professional trading are very, very different from retail mindset thinking. Retail thinking is in Zone 1 and Zone 2, which is all about panic and blame. Zone 3 and Zone 4 is where you make money and you keep money by thinking incredibly differently, almost inversely to retail thinkers. Masterclass students, over the next week, I'll actually be releasing a video on the CTKS method version 2. We need to get an overall view of the macroeconomic landscape. What is price doing at the moment? It's continuing to weaken. When we look back at the 9 sell-offs and recoveries in the S&P 500 since 1966, we can see this particular price action is more in line with what happened during the GFC. But just take note, when the GFC occurred, definitely a lot of people lost a lot of money, but the actual rally out of the GFC was nearly 120%. And you can see that's one of the largest rallies that occurred in these 9 sell-offs. The only one that beat it was the COVID-19 recovery. Sell-offs are nothing to be concerned about. Actually, as traders, we look for sell-offs. We're waiting for sell-offs. Because even though the line appears to come straight down, it doesn't. It always wavers around. Many BORSOGers did particularly well in this sell-off. They had their buy orders down lower, and when they could take advantage of that, they actually could take advantage of exiting the trade as well. As professional traders and institutional smart money thinkers, We must do daily, three-dimensional ANF risk management. What is ANF? It's just like a traffic light, against, neutral, and for. When price goes against you, depending on what side of the market you're taking, and the vast majority of people inside our community take the long side, against would mean that prices are decreasing. Neutral just means they're flatlining, just pretty much range bound, going nowhere. And typically for means going up. But some people like to short the market. In that case, ANF would represent the exact opposite. The key is ANF and putting in your ANF code every single day, or your BORSOG code as we call it, is very much about you doing your daily risk management. You must know what you will do if the market goes against you, goes neutral, or goes for you. And that's not just with your specific trade, that's your entire portfolio. You control the trade or investment, but the market controls the return. You cannot force the market to give you what you want. The market will never know you. It's not personal. The market just doesn't know you, but the market knows your knowledge. That's why putting in your BORSOG code each and every day will help you to define your own risk management strategy. It's part of three-dimensional thinking. The key to understand, if you don't have a strategy, you're basically just gambling. And if you're gambling or guessing or hoping, the market will take your money. Putting in your BORSOG codes each and every day is incredibly important. It shows the market that you respect its power. It enables you to think in three dimensions simultaneously. It's one of the most powerful ways to do your risk management. It's time incredibly well spent. And the beautiful thing, the market will reward your knowledge and your ability to pick up the jigsaw pieces. Literally, the data of the market is just like one gigantic puzzle. And each and every day you do your BORSOG code, you're telling the market, I'm paying attention. And paying attention to the market and respecting the market's power will absolutely make the difference to your profitability. Well done, everyone. You're just awesome people. And as Michael said, its sharp angles reflect. And thank you, everyone. And for Oscar, well done. It is Rule 19. And well done, Andrew. Nailed it yesterday. Okay, let's get back into it. The question is, have we reached a bottom? Where could price be going in the next couple of days? To understand the answer to this question, we must look much more deeply than what most people do. Understanding the macro picture is really quite important. When we look at the UK, its GDP came in lower than anticipated. That means the market is restricting on itself. When we look at the US PPI and core PPI, the PPI came in hotter than anticipated, and that's a forward expectation on consumer inflation rates. The PPI is the producer price index. The big thing that we saw just recently is the CPI coming in hotter than expected, and the CPI year over year coming in hotter than expected, and the core CPI coming in hotter than expected. Much of monetary policy, and that's what the Fed is doing, it's restrictive monetary policy. Much of that is based on the concept that you can either have inflation or have employment. And if you want to bring down inflation, you have to get the market destroying demand and people losing their jobs. And the Fed saw that people were losing their jobs, and they were very happy about that. Because in their eyes, that means inflation restriction policies are working. What an archaic methodology of managing an economic system. That's because central banks cannot fix the supply issues that cause inflation. They can only destroy demand. When you look at these statistics, it's important to understand the rationale and motives behind the key players. What are they seeking to do? If we've got an increase in job numbers, that's bad because the Fed's not doing its job properly. They need to kill employment. They don't want to see employment increasing. It sometimes mystifies people as to what direction these statistics should go. Just think of the motives behind the people making the decisions. And how does it relate to core retail sales? It was actually stronger than anticipated. A lot of people would say, oh, that's fantastic. Retail sales, economic activity is perking up. That's exactly the opposite of what central banks want. They want to see core retail sales fall. They want to see people lose their jobs. So when you see core retail sales coming in hotter than anticipated, that actually is really bad, because the central banks say, ouch, we have to increase the federal funds rate. And what about consumer sentiment? Consumer sentiment is how positive people feel about the economy. It came in hotter than expected. Central banks don't want this. They want people to feel depressed about the economy. So what do central banks do when they see the economy is strong but there's a lot of inflation? Well, there's only one thing that they can do in their small-minded thinking. Sorry, central bankers, but it really is. They can only kill jobs. They can't fix the problem. They can only kill employment. How do they do that? They raise the price of money, the cost of money. How do they do that? They influence interest rates, both short-term and long-term, through the federal funds rate in the US. And what do we see here? In about 19 days, the probability of a 75 basis point increase in the federal funds rate is 99.4%. All of that great economic data just shows that the Fed is not doing enough to kill employment. This means that there are a couple of other pieces in the economic jigsaw puzzle that you must understand. One is the DXY and the other are yields. Long-time viewers of the channel will know that I drew this box in a couple of days ago. That's a 5% federal funds rate prediction in April 2023. The 5% is what is expected to happen within the economy by April, but it actually goes all the way out to December of 2023 as well. So what you can see is we're basically arrived there. About 5.5% could be the maximum that we could look at. So I could extend this box up, but how likely is 5.5%? We can answer that question too. What we actually see, 5.25 upwards is about a 7% probability. So there's about a 93% probability that the federal funds rate will be below 5.25%. So what I'll do is actually extend that box upwards a little bit to 5.25%. So there's a 93% probability that in 13 months' time, we could have a 5.25% federal funds rate. Of course, there's a 93% probability that we won't get anything above that. So when you see headlines like this, exclusive Fed's Bullard favors front-loading rate hikes now with wait-and-see stance in 2023, you know that's exactly what they're doing. We have the charts. We can tell what they're doing. The concept that we're seeking to understand is the bottom in. When people get into markets, they want a simple answer, yes or no. Is the bottom in? Yes, it's in. Fantastic. Can I buy at the bottom? Oh, the bottom was in. It's already passed. That's actually why it's a fantasy to want to try at the bottom. Just ride the sweet spots in the market. So what we're seeing is we're getting a lot of front loading here. This will make a lot of sense. What happens when yields come down? You can see the 2-year, the 20-year, the 5-year, the 10 and 30-year are pulled up with the federal funds rate. Of course, because they flow into it. But what happens when the federal funds rate starts to come down or yields start to come down? We see a decreasing of negative price momentum and typically an increasing in crypto of positive price movement. You want to always bear this in mind. It doesn't always happen, so you have to be very, very careful about that. A lot of people, when they're new to the markets, they say, oh, yields just went down. The stock market and crypto is going to rally. Not so fast. You can have lags and delays, but understanding how yields impact prices is very, very important. And you'll find that yields sometimes move with prices in a direct relationship. Yields go up, prices go up. But we're seeing the exact opposite at the moment. So be aware that these associations can and do change over time. The real thing to consider, why was there a rally? There was actually a reason for it. And you can see if we get rallies in the stock market, we will get rallies in crypto. To understand this, we must understand geopolitical influences on the DXY. And understanding how politics impacts the financial markets is also incredibly important. What basically happened, the finance minister was indeed sacrificed because the monetary policy of the UK was just simply too tight, and that killed the pound and drove yields up, which rallied the DXY. The rallying of the DXY brought yields up and then therefore started to tank the markets. And when there was a wavering that the UK Prime Minister would actually reverse those decisions, and we can see that actually happened here. That's why we had this preemptive spike up. But preemptive and sustained are different things. What we see is the DXY was getting weaker and weaker, and it's actually passed below a once support, now resistance level, but it's coming up to test these highs. It's not really over in terms of where the DXY might go. It may well go up to the 114.142 mark, and this would mean that the markets would sell down. One thing to bear in mind, the US dollar currency index is actually a measure of the US dollar compared to a basket of other foreign currencies. And what are those currencies and what are the weights? By far the largest component is the euro with 57.6%, and you'll notice the Great British Pound around 12%. And what you saw basically with the problems that were happening in the UK government got so restrictive on their policies that it caused a systemic break inside the financial system that needed to be fixed, and that's exactly what they did. So considering the impacts of foreign governments on the DXY is really, really important. So is that all we need to look at? Is we just keep an eye on the DXY and yields and federal funds rates and all done? Not quite. Throughout Europe, inflation is being driven by an energy crisis. I recently put out Rule 837 in Coffee Club, video 15. Look deeper. This will explain a lot of the intricacies of the European energy crisis. And if you really want to understand things, I would suggest looking at that video. As a result of Russia's invasion of Ukraine, Russia uses energy as a geopolitical weapon, especially inside Europe. And that's been a major cause of inflation throughout the entirety of Europe. And Vladimir Putin has been talking about using nuclear weapons. From the Russian newspaper, it's expected that the Russian special operation is expected to last another 6 months. Hence, the probability of a nuclear war coming straight from the Russian general's mouth is probably pretty low. 6 months to finish. If they were going to nuke the Ukraine, we wouldn't anticipate comments like that. Geopolitically, there's also problems in the Taiwan Strait, and this is causing a military buildup in that area. Also, North Korea has become increasingly more hostile, and it's seeking to do its own nuclear test. So you can see, when we look at a chart, we must analyze and keep in our heads so many different data points. To become a professional trader and a professional investor as well, you need to keep so many things at the top of your mind. If you're just looking at price momentum only, that will give you one picture, but it doesn't give you all pictures, not even close. And the reason I developed the CryptoTradingKS Masterclass was to pass on my 30 plus years of experience in financial markets. And I'll be reaching out today to the very lucky awardee of the Tails CTKS Partial Masterclass Scholarship. If you've applied for the scholarship, please keep an eye on your emails. Volatility in the markets is an enormously profitable thing to be a part of. There are so many things that we need to keep our mind on. In order to action Rule 359, be on the right side of the percentage. One really important thing to understand, price will ping between institutional buy levels and institutional sell levels. And I'll keep you updated each and every day on those. When we look at global markets, we can see the global markets are actually all following suit in terms of what is happening to the US market. And this is not surprising because about 60% of global investment is actually in the US market. What else can you keep your eye on as a professional trader or investor? And Masterclass students, you get my live charts in TM6. Keep your eye on the VIX. The VIX is very important. When the VIX is elevated, we see prices come down. And we can see that the NASDAQ 100 is still below resistance. This resistance line, we blipped above it and now have fallen below it. Bond prices continue to collapse and bond yields continue to spike up. And you'll get deep dives on all of this inside the masterclass. We can see from a geopolitical risk stance, gold is coming down and the dollar is coming up. What we actually see in times of great turmoil, gold tends to rally up. We're not seeing that behavior. So the concept of a nuclear strike is being reflected inside the commodities markets. We know that there's a lot of problems with energy globally at the moment. And when we look at oil, oil is starting to base. It's starting to find a level of support. And when we look at junk bonds, which is a very risk-on indicator, and risk-on just means if junk bonds goes up, we expect the markets to go up. If junk bonds are coming down, we expect markets to come down. We can see a loss of support here. All of this should actually give you another piece of the jigsaw puzzle to answer the question, is the bottom in? There are 4 stages that all investors and traders progress through to become consistently profitable. Zone 1 and Zone 2 are the light switch phases. People want simplistic answers to very, very complex questions. It's literally, is the light on or off? You can see it just doesn't work that way. Inside Zone 3 and Zone 4, which are professional zones or institutional zones, we don't have a light switch, we have a dimmer. We basically turn the power on slowly and turn it off slowly. You can see that you will get a lot of different insights over different economic measures. When people are inside Zone 1 and Zone 2, they expect a very simple answer, but professionals know that each piece is part of a larger jigsaw puzzle, and they seek to put that ever-changing jigsaw puzzle together each day. This is what we're all about, and this is what the CTKS global family stands for. We put the jigsaw pieces together each and every day. To become consistently profitable in any financial market, you must gather as many jigsaw pieces as you possibly can and fit them into a consistent story. And that story is not one that you reign over. You seek to actually understand what the market is trying to tell you. That's not your interpretation of the market, that's the actual voice of the market. You won't understand the market's voice when you start. It does take a lot of time. That's why we have the CTKS Creed. I am dedicated and committed. I win or learn and never blame. This is designed to keep you in Zone 3 and Zone 4. Why do we have dedicated and committed? You have to be dedicated and committed to find that missing piece of the jigsaw puzzle. Why do we have I win or learn and never blame? Jigsaws can be quite complex things to put together, especially when a lot of the pieces look the same. And it's exactly the same in financial markets, in the stock market, in Forex, and especially in crypto. If you pick up the wrong piece and you put it into the puzzle in the incorrect space, you'll find that you'll get angry because, hey, something just went wrong. But it's all about learning. Don't worry about getting anything wrong. You either win or you learn. That's why we don't blame. This episode is a very different video than the ones that I usually do each day. I just wanted to reach out and help people, just from an attitudinal perspective. There's so much data that you need to look at. It's not simple to make money in the markets. And when people say it's really simple, those people haven't been in the markets for decades. A lot of people will say the bottom is in. What do you say? Do you think the bottom is in? And complicating markets right now, we've entered weekend action. And weekend action means that there's low liquidity. What does that mean? What's low liquidity? That's another piece of the jigsaw puzzle. Low liquidity means there's not a lot of money floating around. So prices can move quite by substantial amounts up or down. With Bitcoin, and you know Bitcoin will impact your beloved alts because no alt can escape Bitcoin's gravity. Just keep your eyes on these smart money buy levels and smart money sell levels. It will make the difference. This has been a really different video from the ones that I normally do. I'm always thinking about ways that I can add value to you. Just do something or anything to help out. Most of the times, just understanding the market is just one big jigsaw puzzle. And literally every day the board gets thrown up in the air and all the jigsaw pieces scatter. It's your job as a crypto technical analyst to identify the pieces and reform today's picture. Do your very best to keep away from being a light switch. Light switch behavior tends to go all in or all out and seek very simplistic solutions to very complex problems. Instead, think about yourself as a master professional, a master jigsaw builder. You love the idea of picking up all those jigsaw pieces that get thrown up and down each and every day. And the funny thing is, the more jigsaw pieces that you can find, the clearer the picture will become. And please remember, crypto is volatile. Always prepare yourself for the best and worst case scenarios. Reality will likely be between them. Stay safe out there, my friends. Take care and see you next time. Bye for now.